Hello, everyone, and welcome. I'm Annie Collier with REOX and the Legal X, and I'm excited to have you all joining us here today. Thank you for taking the time to be here for the REO and foreclosure outlook for 2026, and this will be a data-driven briefing. We're especially grateful to have Rick Sharga here with us. Rick, as you all know, is one of the most industry's most respected housing market analysts. And today he's going to be sharing data, trends, and insights into what we can expect in the REO and foreclosure space as we head out of 2026 and into 2027. So we'll save some time at the end for audience questions. So feel free to type those throughout the presentation as they come to you. And you should see a Q&A box to drop those in the chat, and we'll get to as many as we can. So with that, Rick, thank you for being here, and I'll now turn it over to you.
Thank you, Annie, and thanks everybody for spending some time with us today. Delighted to be here. We're going to cover an awful lot of ground in a fairly short period of time. Any of you who've seen me do these presentations before know that we're going to go through a lot of data and in pretty short order. Annie does have a copy of the presentation and is free to distribute it to you afterwards. So you don't have to take copious notes if you're so inclined. We will be able to share this with you, and I noticed that the webinar is being recorded as well, so there will probably be a link available. We're going to take a look at the economy. We're going to take a look at what's going on in the overall housing market, and then do a bit of a deeper dive into what's happening in the world of delinquencies, defaults, and foreclosures. Share some closing thoughts, and then we'll do some Q&A if there's anything you're interested in exploring further. Economically, we're in a really interesting position right now. The Atlanta Fed does a report they call their GDP Now estimate that more or less tries to track in real time what we get in subsequent months once the government has figured out what the GDP was in the prior quarter. They've recently reduced their forecast in Q2 to about a 2.6% growth rate, which puts them more or less in line, still a little bit more positive, but more or less in line with the consensus from the top economists across the country. Just this morning, in fact, the government released an update of the first quarter GDP growth, and it rose from a preliminary estimate of about 1.6% to about 2.1%. So we actually did better in the first quarter than was originally believed. Maybe that'll hold true in the second quarter as well. But it does show that consumers, businesses are continuing to spend money. For those of you who follow this sort of thing, the GDP, as you know, is sort of economist shorthand for what the economy is doing. And about two-thirds of our economy, about 64%, is made up of consumer spending. So as consumer spending goes, pretty much so goes the economy. Housing has a significant impact in the GDP numbers as well. But bottom line is, even with all that's been going on in geopolitical turmoil and oil prices and so forth and so on, the GDP continues to grow. Nobody's talking about a recession at this point. And so the forecast for the rest of the year is moderate growth, not a booming economy, but not an economy that's going into negative territory either. That suggests, by the way, that employment numbers will remain pretty stable. And if you're really looking at fundamentally the number one metric I look at in terms of foreclosure activity, it's unemployment. And we'll get into those numbers in a minute. But strong economy typically equates to strong employment numbers as well. The stock markets are hitting new highs. This data is about a week old, and so you know that it's bounced up and down a whole lot since then. As of today, we are now experiencing, I think for the first time, Dow 52,000. I did not have that on my bingo card for 2026, but there we are. The Nasdaq is up about 300 points today. The S&P 500 is up. Interestingly, a big difference this year in the S&P 500 from last year, excuse me, is that the so-called Magnificent Seven, the big technology stocks, are not driving the growth this year. It's the other 493 stocks that are actually driving a lot of the growth in the S&P 500. But from an economic standpoint, GDP is doing well. Stock market is going crazy and doing better than most people had forecast it would. And a big part of the current rally probably has to do with the fact that oil prices are continuing to fall. When the war started and the Strait of Hormuz was completely closed and then reclosed by us, we saw oil prices jump up to close to $120 a barrel. As of this morning, they're actually below $70 a barrel. So we're almost back to where we were prior to the war starting, which means that we should see energy prices start to come down a little bit. And that'll be good again for the overall economy, certainly for the cost of living that impacts a lot of our households. The IPO market is also very hot. SpaceX, if you've been following, had I think the largest IPO in history, became at least briefly the fifth most valuable company in the world a week after it went public. Its stock has trailed off a little bit in the last couple of days, meaning that Elon Musk, poor Elon, is no longer a trillionaire. He's now worth only something like $975 billion. So I don't know. We may have to start a GoFundMe for Elon at this point. But stock market doing very well, both in terms of how it views the overall economy, in terms of corporate earnings being very strong and the IPO market being very strong. We have a couple of AI startups, or they're big startups, but looking at IPOs this year as well. So that part of the market should continue to do pretty well. Inflation, we saw another inflation report come in this morning. The PCE, the pricing index or the production index, came in a little higher than we would like. It was at 4% year over year, but most economists believe that's the peak and it will start to retreat from there. Until the war in Iran started, we actually had been seeing inflation come back down. Wasn't back to the Fed's 2% target, but it was coming in the right direction. It was down to about 3.6%, 3.5% year over year growth until oil prices jumped. And you can see the chart on the left with the bar chart that almost all of that increase in inflation was due to energy costs going up. That was due entirely to the price of oil going from under $70 a barrel to over $120 a barrel. And theoretically, at least, as those oil prices come back down, we should start to see energy prices come down and inflation start to move in the right direction. I do want to point out, and I like this longer view of the chart on the right, just as a reminder, if you look at U.S. inflation and you go back as far as the data is reliable, maybe 50 or 60 years, the average rate of inflation in the U.S. on an annual basis is typically somewhere between 3.5 and 3.6%. So with the exception of May's numbers, which again were driven by the burst in energy prices, that 3.6 number, 3.5 number that we were looking at, while it was higher than the Federal Reserve's target, wasn't out of line with what we've seen historically. And so, again, I'm hopeful that we'll see those inflation numbers come down. A lot of what we're seeing in terms of consumer issues with cost of living and so forth and so on really has to do with that spike you see on the right-hand side of the chart on the right, when inflation ran up to over 9% for a period of time, and stayed much higher than usual for the better part of about 18 months. Prices have not gone down since then, and that's the important thing to keep in mind. They've continued to go up. They've just been going up at a slower pace. So it takes a while for consumer finances to catch up with those kind of unusual eruptions, if you will, in the cost of living. And I think that's why people continue to be a little bit sour about what's going on. Unemployment, I mentioned earlier, is probably the biggest predictor of foreclosure activity. Unemployment is holding steady even this week at about 4.3%. Now, the duration is increasing. And what that means is about a quarter, a little over a quarter of all workers on unemployment have now been unemployed for 27 weeks or longer. That's half a year. And it suggests that people are having a hard time finding that next job once they've lost the one they were currently working in. That's a trend to watch, to keep an eye on. We're certainly not back to some of the Great Recession kind of numbers that we saw for a number of years. It took us about 10 years to recover from the recession that started back in 2008. Um, I also suspect these numbers are a little bit inflated because I know people that are unemployed that are basically doing gig work and paying the bills like that while they're trying to figure out what they want to do next. So there is probably a little bit of fuzz in those numbers, but the Mortgage Bankers Association reminds us that there is a very, very strong correlation between unemployment rates and mortgage delinquency rates. In fact, if you look at their last quarterly report, which was the end of last year, their mortgage delinquency rates were about 4.28%. Unemployment rates were 4.3%. So again, if you want a predictor in terms of what's going to happen with mortgage delinquencies and defaults, keep your eye on unemployment. Job numbers have been a little bit stronger than forecast. The last numbers really literally crushed the forecasts. The forecast was for about 70,000 new jobs. We came in at 172,000. So that's three consecutive months where we've had better than expected job numbers. And the jobs are kind of across the board. The good news here, if you're looking at the economy kind of writ large, is that these job numbers that are increasing are not increasing because the government's stepping in to hire a lot of people. In fact, federal government jobs are down about 10% from where they were a couple of years ago. So these are all private sector jobs coming in. We're starting to see an increase in construction jobs. We're starting to see the manufacturing segment kind of balance out a little bit. So it'll be interesting to see how that continues to play out over the rest of the year. And wage growth, this chart's a little misleading because it looks like we're in negative territory. We're actually not. Wage growth is about 3.4% on a year-over-year basis. That's not as high as we would like, but it's not a bad number historically speaking. Up until last month, wages have been growing at a faster rate than inflation. That was a good thing. Hopefully, that will be the case again when we see subsequent inflation reports, and there's a chance that they come down as energy costs recover. Consumers, meanwhile, are not feeling terribly good about what's going on. Consumer sentiment is at an all-time low. I'm showing two charts here. One is consumer sentiment, one is consumer confidence. And the reason I'm showing them is because they measure different things. You probably see these in the headlines all the time. And honestly, I used to see them and not know what the difference was between the two. But consumer sentiment is pretty much a cost of living sentiment. And it's how difficult is it for me to pay my rent, pay my mortgage, pay my electric bill, fill the tank with gas, and buy food for dinner. It's a cost of living index. And as I mentioned, not a big surprise because cost of living spiked a few years ago and we had that unusually and almost historically high inflation and really hasn't come down since then. It's just been going up more slowly. And recently we've seen costs go up more than wages have gone up. That recent spike in gas prices really hit the wallets pretty hard for a lot of households. Consumer confidence, on the other hand, is more about my job. Do I feel confident that my job will continue to exist, that I'll continue to be employed, or that I'll be able to find another job if I'm not happy with the current one? So, in terms of how we're doing relative to confidence about the jobs market, again, much closer to a positive value. You want to be at or above 100. We're close to that. On the other hand, the consumer sentiment index really needs some work, and it shows how sour people are about the overall economy. One of the reasons for that is that we've seen, and this is kind of a confusing chart, so just take my word for it. We have seen disposable income dip a little bit while we've seen people spending more money. So they're laying out more money while their disposable income is contracting a little bit. Because of that, the personal savings rate is down to about 2.6%, which is about as low as it's ever been. So it suggests that people are dipping into their savings in order to make ends meet. That's not a good long-term scenario. And we do need to see some of these situations begin to reverse themselves, or we will wind up with some economic issues going forward. Consumer debt is also at an all-time high. And this is one of those good news, bad news slides. Total debt is at about $18.8 trillion. That's a big, big number. But for the first time in probably the last 2 years, we actually didn't see that debt number go up in the last quarter. And this is data compiled by the New York Federal Reserve Bank. So it stayed pretty much exactly where it was the prior quarter at about $18.8 trillion dollars. And about 70% of that debt, by the way, is mortgage debt. So about 13-ish trillion dollars of that 18.8 trillion is mortgage debt. And that's viewed as relatively safe because it's offset by about 35, 36 trillion dollars of homeowner equity. Not that said, we're still at an all-time high in terms of auto loan debt at about 1.5, 1.6 trillion dollars. We're near an all-time high in student loan debt at about 1.6 trillion dollars. Credit card debt is not at an all-time high, but it's not far from it. It's 1.2, 1.3 trillion dollars. And that's at a time when the average credit card interest rate is over 25%. If you have a department store credit card, if you shopped at Macy's during the holiday season, make sure you pay that thing off because department store cards typically have interest rates these days of 35, 36, 39%, which used to be usury and get you arrested, or was what the interest rate you'd get from somebody you borrow money on the docks, and the repayment terms were a little bit more severe there. Delinquencies, on the other hand, had been rising. They'd gone up for, I think, 10 of the last 11 quarters before they dipped a little bit in the last quarter. So delinquencies actually improved a little bit. The total number of delinquencies across the board based on the balance of these loans. Even with those increases in delinquencies, by the way, we're not yet back to where we were prior to the pandemic. So we're not, again, nowhere near where we were back in the Great Recession days, and not quite back to where we were before the pandemic. So trending up, but not trending up to numbers that would become overly alarming. I will point out that delinquency rates vary by cohort, and we'll get into that a little bit later. But the best performing loans right now actually are mortgage loans. Credit cards, auto loans, student loans not doing quite as well. And again, that suggests people may be tapping into their credit cards to make ends meet, which also is not a good sign. On the housing market itself, which of course has a very strong correlation to what we're going to see in the foreclosure market, affordability got a little bit worse in the last couple of months, and that was despite wages growing. And the chart on the right, the blue line you see, is wages. It's the average income, the median income, if you will, of a U.S. household. The orange line on that same chart is the median income you would need to be able to afford to buy a median priced home while only spending 30% of your income on your housing costs. So that's a lot of medians. Median income of a household, median income needed to buy a median priced home. That means it doesn't really apply to everybody. Not everybody's buying a median priced home or as a median income. But this information from the Atlanta Fed really is a pretty useful index, and it shows you just how bad affordability got in the middle of 2022, when despite the fact that wages continue to increase, when those mortgage rates doubled, it just messed up affordability almost beyond belief. And affordability had been improving. You see that orange line kind of trending down until oil prices shot up and mortgage rates went up with them. And that increase in mortgage rates obviously skewed the numbers in a bad way for homeowners. The hope is, and mortgage rates have actually been coming down a little bit in the last couple of days. The hope is as those rates come down a little bit further, that affordability again will improve. But you can see the chart on the left, which is a longer term chart. Affordability, the further above that bar you see running across the middle of the chart, the less affordable properties are. And again, same sort of thing right there. You see that affordability there is not at its all-time worst, but not particularly strong. And we need to see those numbers come back a little bit. Affordability on a whole is a little better than it was a couple of years ago. But it doesn't mean that everything is affordable for everybody. It just means that more homes are more affordable for a few more people. I mentioned those early stage delinquencies. I think I got these out of order. But the transition of loans going from current to delinquent uh, are still higher than what they were prior to the pandemic. We've seen a little bit of an improvement in student loans, but still converting into delinquencies at high levels. That has some very specific impact on mortgages. But what you can see is that in just about all categories, credit cards, auto loans, student loans, they are all trending delinquent at a higher rate than they were prior to the pandemic. Mortgages are still slightly lower than they were prior to the pandemic in terms of those delinquency rates. And if you look at 90-day delinquencies, you can see that credit cards are almost at the same level of serious delinquency they were during the Great Recession. Student loans are approaching that. Auto loans are actually higher, one of the highest rates of serious delinquencies we've seen on record. And again, but on the other hand, HELOCs and mortgages not really out of line with historic numbers and actually doing better than they were prior to the pandemic. I mentioned that student loans could have an impact on our market, and the reason for that is that we now have 5 million student loan holders who are seriously delinquent, more than 90 days delinquent. Another 4.5 million about to fall into that category. Once a student loan borrower goes 10 months delinquent, the federal government can start garnishing wages, and those wage garnishments on average would be something like $700 or $800 a month. That's a big hit to somebody's monthly household income. We know that student loan borrowers are more often delinquent on their mortgages than people without student loans. We know that people with student loans are less likely to take on a mortgage than people without student loans. So the more we see these student loan delinquency rates ratchet up, and the more we run the risk of the federal government starting to garnish wages, the more of an implication there could be for delinquencies and defaults in the mortgage industry. And consumer and commercial bankruptcy filings still not back to where we were again prior to the pandemic. If you go back to 2020, have been steadily increasing. They've increased now for 4 consecutive years since coming out of the pandemic. Consumer filings were up to about 142,000 in the first quarter of this year. Commercial filings were up about 14% as well. So we are seeing bankruptcies come up. Speaking with servicers, I know at least anecdotally, we are seeing distressed homeowners use bankruptcy as a way to delay foreclosure proceedings. As most of you probably know, a bankruptcy won't dismiss a foreclosure, but it can delay it for a while. And I expect some of these consumer filings that we're seeing are probably people trying to delay a foreclosure. But again, go back to the last couple charts, and you can see that with consumer debt being what it is, with delinquency rates on consumer finances being what they are, probably not a huge shock that we're seeing bankruptcy filings go up a bit. Getting back to affordability in the housing market, this was from June 16th, so it's a little dated, although only 10 days. And interestingly, as of yesterday, we were back to almost exactly the same number. The Mortgage News Daily number yesterday, end of day, was 6.55%. So that's about 30 basis points, 35 basis points lower than we were a year ago. It's down from about 6.75% a couple of weeks ago when we had the recent peak due to oil prices spiking and what it was doing to the bond market. I did notice that yields on the 10-year bond today were down to about 4.3% and coming down a little bit. All of that helps with mortgage rates. And again, as these rates come down even a little bit, it does stimulate more buying activity, and it does make homes at least slightly more affordable. Most of the economists that I follow have recast their estimates for mortgage rates this year. Some of the more optimistic ones had been hoping that we'd end the year with mortgage rates somewhere in the fives, not low fives, but at least high fives. And most of them have recast their numbers, and everybody's in the sixes right now. The MBA and Fannie Mae are both forecasting that we'll end the year this year at about 6.4%, which again better than it was a year ago, but not as low as we had hoped. Meanwhile, home prices are flattening out a little bit, and that's a good thing. So two different charts here, and I picked these two because I follow them, but you can look at reports from the NAR, you can look at reports from Freddie Mac, a variety of other sources. The one on the left here is the FHFA. As you probably know, that's the governing body that controls Fannie Mae and Freddie Mac. So this is an assessment of home price appreciation on properties that are sold that have those loans. And the most recent data they have available is from March, so it's March to March numbers. And what they're showing is that home prices only went up 1.7% year over year. That's down from about 4% a year ago. So the same index, home prices were going up 4% year over year last year. They're only going up 1.7% this year. And you can see there are some markets like the western south central part of the United States. I believe that would include places like Colorado and Nevada, Utah. We're seeing prices actually down a little bit year over year. The Pacific region, we're seeing prices flat. The West North Central, the South Atlantic, where Florida is, we're seeing prices go up less than 1%. So that's also helping affordability out. And we'll get into a more localized view on this in a minute. The chart on the right is the Case-Shiller index. Is probably the most widely quoted index in the industry. And they showed that prices were going up by nationally by 0.7%, less than 1% on a year over year basis. In their composite 20 index, where they measure data coming in from 20 large metro areas, they were showing negative year over year growth in about half of those markets. If you break it out a little bit more granularly, if you look at the map on the left, that's the change in metro level home prices, April 25 through 26. And what the data shows us, and you can count the dots later if you'd like, just take my word for it, is about a third of the top 300 metros actually showed prices going down year over year. Now, the other two-thirds were either flat or going up. And there's a regional variation here that's pretty obvious. If you look at the Gulf Coast states, if you look at Texas and Florida, which candidly got a little bit overbuilt over the last couple of years, and where migration has slowed down a little bit, you can see property values down. Austin's down 6% year over year. Cape Coral's down 7% year over year. Punta Gorda, which is a fun town to pronounce, is also down about 9% year over year. And then there are some outliers that were markets where we saw prices really escalate rapidly coming out of COVID, like Phoenix, like Las Vegas, like Boise, Idaho, like St. George, Utah, where prices are also down year over year as those markets kind of correct a little bit. The Zillow forecast, the Zillow economics team, I know a lot of you don't like Zillow's estimates, but their economics team actually does a pretty good job of their forecasting and market analytics. They're forecasting that prices will actually go down nationally just by the most minuscule amount, 0.1%, but still negative year over year between this April and next April. And you can see some of the same patterns across the country with a little bit less blue, a little bit less in terms of prices going up. I'm forecasting this year that home prices at the end of the year will have gone up about 1.5% to 2%. But the numbers vary dramatically and will show the potential impact for short sales and foreclosures as we move forward. Interestingly, list prices are a little bit lower. So Housing Wire tracks list prices using Altos research data. And what they're showing is year to date, list prices are down about 3% nationally, which again is helpful from an affordability standpoint for buyers. And that slightly fewer homes are getting list price reductions than what we saw a year ago. I don't know how many of you are familiar with this, but about a third of all properties take a list price reduction before they're sold every year. And that's just kind of historical averages. Since the middle of 2022, we've seen that the percentage of properties with a list price reduction consistently higher than that. And numbers really got fairly high last year. We were over 40% of the properties getting a list price reduction between the time they were listed and the time they were sold, which is unusually high. We're at about 37, 38% right now, which is better. Still a little bit higher than usual, but showing that um, buyers are being probably a little bit more stubborn and sellers are being a little bit more willing to negotiate. Before you get the wrong idea here, this is not an indication that sellers are selling at fire sale prices. The average list price reduction is less than 5%. So it's enough to be meaningful, but not enough to suggest panic selling, which was one of the factors that led to the house price crash back in the Great Recession. Inventory is still growing in most markets, but much more slowly. And the two maps I'm sharing with you here, the map on the left is showing the growth in inventory in May this year versus May last year. The map on the right is showing inventory May this year compared to what it was prior to the pandemic in May of 2019. And what you'd see on the map on the left is that we're starting to see some of the states that have been having rapid inventory growth, like Florida and Texas, reverse course. Florida in May actually had 14% less inventory than it did a year ago. That's important because we also, remember, saw home prices going negative in Florida. So that whole Econ 101 thing about supply and demand really factors in here. The more supply you have, the more buyers have choice, the less competitive bidding that you have, the more important it is to get those inventory levels back under control. The three states with the biggest inventory reductions year over year were Florida, Alaska, and North Dakota. But you saw Texas at 0% growth year over year, California down a little bit, which is probably why California prices are going back up. And then again, if you look at where inventory has grown the most since we got out of COVID, it's states like Texas and Tennessee and Colorado and Arizona and Utah and Washington State. And all of those are states where we're seeing prices impacted a little bit. And in fact, that's an important point to reinforce here. If you look at the brown states on that right-hand side map, it's mostly the Midwest and Northeast. And that's where home prices are continuing to go up. They're not going up by double digits, but you're still seeing markets like Hartford with a 6% year over year growth in sales prices. So a direct correlation between inventory levels and home prices. And that's important for you to know in your states or in your local markets as well. So inventory, while it has been growing a little bit, is basically on par with 2025. New listings have been very disappointing this year. The most recent numbers we got at Housing Wire showed a little bit of an improvement. They do weekly listings as opposed to monthly, which you get from other sources like Realtor.com or the NAR. But we're seeing a little bit of an improvement over last year's numbers. The rate lock effect is real. There are still a lot of people who either can't or won't sell their house because they're financially unable to sell that house and take on a bigger mortgage, or they just don't want the increased expense. We're also seeing a lot of people aging in place, boomers in particular, who have amassed an enormous amount of homeowner equity. There are over 17 million people across the country that have more than a $500,000 in equity. The reason I'm bringing that up is that means if they were to sell their home, they would be getting hit with a massive capital gains tax hit. And a lot of people just aren't willing to do that. They'll instead take out a home equity loan, modify and remodel their house to make it more livable, and just age in place. And I think that's something the government could and probably should take a hard look at. Is adjusting that capital gains tax waiver if they're really serious about trying to get more homes to market. The reason I'm hopeful for the housing market is these two metrics that I follow on a pretty regular basis. One is the MBA's mortgage purchase application index, and the other is weekly pending sales that we get from Altos Research through Housing Wire. Both of these are running ahead of last year. So we are seeing more pending sales, which is contracts that have been entered into, but the transaction hasn't yet cleared. The property hasn't, the title hasn't moved. And obviously, purchase applications are from people who are applying for loans in order to buy a house, and they wouldn't be doing that unless they were actively trying to get a house. Every time we see mortgage rates dip even a little bit, we see both of these metrics jump up. And the hope is again as mortgage rates come down, even if they come down by a little bit, 6.4%, 6.5%. We should see these numbers trend up a little bit, and it tells me, it reinforces my belief there is a lot of pent-up demand out there, just waiting for market conditions to be even a little bit better. Days on market is also down. These numbers vary. I see different numbers from different MLSs, different realtor associations that they're all over the place. But I do look at the Realtor.com numbers just as kind of a consistent gauge. They had recently been up as high as 56 days on market. They're now down to 52, and they've been trending down for the last couple of months. So still a little higher than we were a year ago, but better than what they've been in recent weeks. So that combination of shorter days on market, more people applying for loans, more pending sales, home prices moderating a little bit, mortgage rates coming down a little bit, are all positive signs for the housing market going forward. I'm not expecting a boom in home sales anytime soon, by the way, but I'm hoping that we reverse this 3-4 year trend of really below normal levels of purchase activity. Along those lines, both April and May were a little bit helpful. May was actually up about 3% year over year and month over month. And that's a good thing. That actually beat most economists' forecasts. That was the second month in a row we sold more homes than we did the year prior. That reversed a 3-month trend where we've been selling fewer homes than we had the year before. I believe it's an indication of pent-up demand. I've been kind of writing off the first quarter because of Mother Nature and the war in Iran. If you look at January and February, both months started off with better home sales numbers than we'd seen the prior year. And then weather hit, and we had unusually severe weather in the Midwest and the Northeast. And if you look at year over year home sales in those two regions, they were off by 6, 7, 8%, even though nationally our numbers were only down by 1 or less than 1%. So I really do believe that January and February numbers were impacted by weather. And March started off pretty well until the war in Iran started. Oil prices spiked. The bond market went a little bit nuts, and we saw mortgage rates go up to close to 7%. And that kind of put the kibosh on March. But as things settled down a little bit in April and May, we actually saw things improve. The preliminary reports we're seeing on June suggest we should be seeing another month of year-over-year improvements. So I am hopeful that as we go through this year, we'll see conditions continue to support better sales. New home sales dipped in April from March, and unfortunately, we just got some numbers yesterday. That numbers fell a little bit more in May as well. They were down about 588,000 sales on an annualized basis. So the builders are having a hard time getting rid of inventory, and that's probably indicative of continuing weakness in the market. Those are numbers that if they hold for the rest of the year, we'll have that part of the market coming in at much lower levels than most of us forecast. I think the kind of median forecast for new home sales this year was somewhere between 650, 675,000 units. I'm still hopeful we wind up somewhere around there. But the April numbers and the May numbers were a little bit disappointing. Now, I will say this. New home sales numbers are always very volatile, and they typically get revised pretty significantly 30 and 60 days after they're reported. Usually they get revised lower, but sometimes they get revised higher. So I wouldn't go to bed expecting these numbers to hold steady. But we'll see what happens. May housing starts were at a 5-year low. It kind of fits in with what we're seeing in terms of builder sentiment, which is also low. Their sentiment isn't great because they're seeing sales slow down. They're seeing traffic slow down a little bit. But we need to complete about 1.5 million homes a year in order to make up the deficit in housing that we have. Builders are being very circumspect about new starts because they're sitting on more than, and now it's more than an 8.5 month supply of inventory. It's closer to a 10-month supply of inventory, which is just too much for them to hold on to. And that inventory includes a record number of properties that are not yet started. So maybe the lot's been cleared, permit's been issued, but they haven't started building. That's the green area there. There's about 110, 115,000 of those ready to get started projects out there, which is the highest number we've ever seen. The blue area is homes that are under construction. That's just down from a record high of a couple of months ago. But we are seeing more of those properties being sold while they're being built. And then we're at a higher than average number of properties that are already completed. So builders are offering concessions. They're lowering prices in some cases. They're doing upgrades in some cases. They are reducing financing charges in some cases. But I expect we're going to continue to see housing starts remain low until they work through some of this backlog of inventory that they're sitting on today. What does all this mean for the foreclosure market? It means that the housing market is not booming the way it did a couple of years ago. Equity is not growing at the rate it grew a few years ago, which was giving a lot of homeowners quite a bit of cushion. And there's not as ready an escape for people to be able to sell their properties, excuse me, at full value as there might have been a year or two ago. So conditions aren't as positive for home owners who find themselves in short-term financial distress. I mentioned that the MBA's fourth quarter 2025 delinquency rates came in at about 4.28%. Their more recent data at the end of the first quarter, delinquency rates came in at about 4.44%, which again, right in line with those unemployment rates that we talked about a little bit earlier. We didn't see a huge increase in new delinquencies. Most of the increase we saw, and again, it was a very modest increase, came in loans that delinquency got more severe. So they went from early stage delinquencies to later stage delinquencies. As we'll discuss in a couple of minutes, a lot of that has to do with the FHA portfolio. The FHA portfolio, in fact, in that same report, had a delinquency rate overall of about 12% of their loans. This is this is kind of in keeping with the notion that FHA delinquencies are always higher than the rest of the mortgage loans that are out there, but it's still higher than normal for FHA, and 12% is a number to pay some attention to. You can see that VA loans also had their delinquency rates tick up a little bit to about 5%. The overall rate, again, 4.44%, lower than historical averages, which usually are closer to 5%. And conventional loans, the Fannie and Freddie book, almost nobody that's not performing on those loans. 2.75% is almost as low as those delinquency rates have ever been historically. So if you're looking for problem areas in the mortgage industry right now, it's almost exclusively FHA and a little bit VA loans. And if you're looking for more likelihood of problems, you want to look at the most recent loan vintages. This chart was compiled by my friend Darren Bloomquist over at auction.com. And if you look at what this is showing you is serious delinquency rates, so 90 days plus, on loans by different vintages. So if you look at all loans, the group on the far left, you can see that 24% of the seriously delinquent loans are from 2000 and earlier, some of those bad loans that led to the Great Recession. Loans from 2008 to 2017 made up 22%. Then if you look at 2018 to 2021, it jumps to 27% of seriously delinquent loans. And the loans in the most recent vintages are performing just as badly at 27%. If you look at FHA loans, you can see that only 7% of seriously delinquent FHA loans are the older loans. 26% were loans that were issued from 2008 to 2017. And it jumps to 35% of seriously delinquent FHA loans in that time from 2018 to 21, and 32% of seriously delinquent FHA loans are loans that are less than 4 years old. You have similar performance in the VA, even more serious delinquencies in the most recent cohorts. That is probably because the VA did not have the toolkit it needed recently to help borrowers who were delinquent get out of delinquencies. The partial claims program for VA was just passed recently, and most economists and analysts believe that will help offset some of these early stage delinquencies in the VA book. And as you can see, the conventional loan book performs completely differently. The most recent vintages have been very healthy in terms of loan performance compared to some of the older loans. Interestingly, we're seeing fewer new delinquency rates, but the number of current loans that move into 30 to 60-day delinquency rates dipped in the last quarter, according to data from the New York Fed. On the other hand, the number of loans that went to 90 days late went up a little bit. So again, not as many, we're not seeing a flood of new delinquent loans, but the loans that are delinquent are becoming more delinquent. And that is a problem for those borrowers, but does not suggest we're going to see a flood of default activity. In fact, if you look at the numbers that came out, and this again is most recent data available from ICE, which used to be Black Knight, the most recent delinquency rates in March, we saw a drop in overall delinquency rates down to 3.35%, which is below their 5-year average and pretty close to a record low. But I wanted to share with you the chart on the right as a reminder that March, generally, we see a pretty significant dip in delinquency rates on mortgages. That tends to be a seasonal thing. It has to do with people getting their tax refunds and paying down some of their bills. And we usually see those delinquency rates on mortgages pop up again a bit in April. And in fact, if you look at the dip in March this year, it was a little bit less than what we see historically. So I suspect when we see more recent delinquency numbers, we will see these numbers tick back up a little bit, but they really haven't been much higher than just below 4% in the ICE data for quite some time. And again, not showing any huge issue with delinquent loans. Now, March also had the highest number of non-current loans, which is loans that are either 30, 60, or 90 days delinquent or in foreclosure. So this is the highest number we've seen since 2021. It's below long-term averages, but it does suggest that we are seeing a little bit more in terms of non-current loans than we've seen recently. Again, not a huge surprise if you look at seriously delinquent loans. It's the FHA book that is driving things. VA numbers are a little higher. The loans held on private portfolios are actually performing extremely well as are Fannie and Freddie loans. At this point, FHA borrowers account for more than 55% of all seriously delinquent loans, despite the fact that FHA loans only account for about 13 to 15% of all loans in total. So hugely disproportionate share of seriously delinquent loans are FHA loans. And I mentioned prices and some of the other trends earlier and what that could mean in terms of foreclosure data. And let's just marry what loans being seriously delinquent and some of those other market trends that I talked about. According to the New York Federal Reserve, excuse me, FHA mortgages are more concentrated in the Southeast. So if you were to draw a line starting in Las Vegas, going through Phoenix and then across the southern part of the country, you would find a disproportionately high percentage of FHA loans. In fact, about 10% of all loans in Texas, about 10% of all loans in Florida are FHA loans. If you look at, sorry, 20% in both cases. If you look at Oklahoma, similar numbers. So all of these states have a higher than national average of FHA loans. What I meant to say was if you look at FHA loans as a whole, 10% of FHA loans are in Texas, 10% of FHA loans are in Florida. Remember what we talked about in terms of home price movements. And if you look at where home prices are declining, it's in exactly the same markets. So you have FHA borrowers with a disproportionately high percentage of mortgages. Remember that the majority of these FHA loans have very little equity because most of the borrowers took out a low down payment loan. And in recent vintages and recent loan vintages, haven't even had time to build up any equity. So now you're looking at a multitude of borrowers with little equity in markets where prices are declining year over year, and in some cases have been declining for a few years. Those also happen to be the same markets where we're seeing the highest increases in insurance premiums and property taxes going up. So those borrowers, FHA borrowers, and not to profile borrowers, but FHA borrowers typically have less equity. They have a higher debt to income ratio. They have lower cash reserves. They have lower income scores, lower credit scores. They're in markets where property values are going down, but their ancillary costs, things like insurance and taxes, are going up. It, in my mind, is kind of a perfect storm for those FHA borrowers. And not shown here, but if I were to show you a chart of where we're seeing the most serious loan delinquencies for student loans, it would be exactly the same states. So really a lot of pressure on those FHA borrowers. This is, again, something that I borrow from my friend Darren Bloomquist over at auction.com, his distressed market funnel. He's about to release some updated data on this, which will show that we are now at a point in time where we have more delinquent loans overall than we had back in 2020. We have a higher percentage of 90-day delinquencies than we had prior to the pandemic. Foreclosure inventory is gaining on where we were back prior to the pandemic. We're now over 300,000 properties in foreclosure. And foreclosure starts are actually running on par or maybe even a little higher than they were prior to the pandemic. We're still not seeing the same percentage of loans go to foreclosure. And the loans going to foreclosure are still selling at a fairly high rate, which means there's not a ton for the lenders to take back as REOs. So the top of the funnel is starting to fill up a little bit more. We're still not seeing that translate into a ton of auction sales or a ton of REOs. That said, ICE has the same sort of data that it's reporting. It's showing that foreclosure starts on an annual basis are up 10% year over year. Foreclosure sales are up about 6% year over year, and foreclosure inventory in their numbers are up by about 29% year over year to the highest level we've seen since 2020. Now, keep in mind, 2019, 2020, we weren't looking at massive numbers of properties in foreclosure, but we are getting back to those pre-pandemic levels. What that has not meant yet is again a huge influx in terms of foreclosure auctions or lender repossessions. We were probably going to see more in the months ahead because there aren't as many foreclosure protections for seriously delinquent borrowers. We saw a recent spike in the number of borrowers who entered a forbearance program. That's been declining. We are seeing, as I mentioned earlier, more bankruptcy filings, but there is a larger percentage now of these loans that just don't have any protections left and are either going to have to sell their property or move through the foreclosure process. That's certainly the case as well in the FHA book of business, where the only area we saw growth in terms of protections is we've seen more people enter their loss mitigation protocols, which, as you know, require 90 days of trial payments before it becomes a permanent loan mod. Now, I said that foreclosure auctions have not gotten back to pre-pandemic levels, but according to auction.com, and this is not just auction.com data, this is all industry data, foreclosure auctions are at their highest level in the last 5 years. So they are starting to come back, but you're still seeing large states in terms of population like New Jersey, like Illinois, where we're not seeing as much auction volume as we saw prior to the pandemic. And even some of the other states, Florida, Texas, California, not nearly as many foreclosures. New York is basically flat compared to where they were. And then the map on the right is showing Q1 compared to Q1 2020. And again, most states not back to pre-pandemic levels, but we are starting to see that number come back a little bit more. So again, ultimately, we wind up as these borrower protections diminish with more of the borrowers going through the entire foreclosure cycle. Um, there are still a lot of borrowers with equity and probably enough equity to sell their house at or at near market value and avoid a foreclosure. But that's diminishing as well because again, we see some markets where property values are going down. We see some other markets where property values are flat. So auction.com is projecting kind of a slow but steady growth in sales throughout this year, going into next year. I tend to think these auction.com numbers are pretty accurate. I don't see a scenario, just given the state of the economy, which is why we started by talking about the economy, where we see unemployment, where we see a recession, where we see unemployment, scale up significantly, where we see therefore mortgage delinquencies ratchet up to unusually high levels, which is kind of a precursor for foreclosure activity. Um, and what they're showing is the number of properties brought to auction. And if you go back to again pre-pandemic levels, what you would see is kind of double this number of properties being brought to auction. And none of us see that scenario happening in the months ahead. So just to kind of wrap up, and then we can take questions if you have any. Consumer finances are under stress as inflation rises, personal savings rates decline, consumer debt is at an all-time high, and we're seeing delinquencies up a bit. GDP forecast had been weaker, but we're still seeing GDP growth, just not explosive growth. But again, unemployment and wage growth are both stable, and the job market is stronger than forecast. So, on the whole, the economy is doing pretty well right now. And there's a lot of kind of a wealth effect created by what's going on in the stock market. Everyone's 401ks should be looking pretty good right about now. Housing affordability is still a bit of a headwind, but mortgage rates are lower than they were a year ago, and home prices, generally speaking, are either flat or coming down in most parts of the country. Now, it varies market to market, so what's going on where you are might be a little different. Two important metrics I continually watch, the delinquency, the mortgage loan applications and pending sales suggest we should see better sales in June and July. Delinquencies are a little higher than in prior quarters, but still lower than historic averages. If you're looking for an increase in foreclosure volume, it's going to be from the FHA portfolio. Servicers that I talk to believe we're going to start to see an increase in foreclosures in the FHA book starting in the fourth quarter of this year and through 2027. That's simply because it takes that long to process these loans. If they go seriously delinquent now, they have at least that 90-day trial period before they get moved over into foreclosure. That takes you into the fourth quarter. And then it depends on your state. If you're in New York, good luck because it's going to be 2,000 days till the sheriff's sale. If you're in Texas or Florida, different scenario, or Georgia. There are going to be short sales opportunities possible in states where we're seeing home prices fall. I would dissuade you from believing entirely some of the headlines you're reading that are promising hundreds of thousands of short sales. That's not going to happen. The numbers just don't support it. But will there be short sales at a higher number than what we've seen in the past few years? Absolutely. And look at markets like Florida, like Texas, like Colorado, like parts of Arizona and Nevada, where prices have come down. And a significant increase in REO inventory is still months down the road. Uh, Again, we're not seeing as many properties even make it as far as the foreclosure auction. A significant number of the properties that get to the auction are being sold to third parties, which means that they're not going back to the lenders. And a lot of these are FHA loans, which mean that before they get transferred back to HUD, the servicer is required to list them with an online auction company. and they go through multiple auction cycles before the service is required to eventually transmit them back to HUD. So it could take a while. So REO inventory is still running at about 35% of where it was prior to the pandemic. It will tick up a little bit. It has been ticking up a little bit, but it's going to take a long time to get back to normal levels. And this possible resolution and, on again, off again ceasefire, but this possible resolution of the war in Iran could reverse the inflation we've seen, energy costs, and with them mortgage rates, and that's what we're all hoping for. So there we go. Annie, back to you. I got through that as quickly as I could, but lots of information, hopefully some of it helpful.
Yes, it was all very helpful. Thank you, Rick, so much. That was incredibly informative, and we appreciate you again being here with us today. So we have received some great questions from the audience. So if we can jump into those real quick.
Sure.
Our first is from actually our advisory council chairman, Steve Pagano. He's thanking you for a great presentation. And are you seeing reduced timelines in judicial states?
Well, if we're talking about foreclosure timelines,
Yes.
the answer is no. In fact, they're getting worse. Louisiana recently set what I think is an all-time record. The average was 3,000 days in Louisiana. Hawaii, as Steve well knows, very difficult to get a foreclosure process there. So, no, we're not. And candidly, the courts aren't staffed up enough to handle much of an influx of foreclosures. So, while I suspect that things will eventually get a little bit better, they might actually get worse before that happens.
Okay.
That said, Annie, across the board, we are seeing, according to Adam, we are seeing foreclosure timelines tick down a little bit year over year. But the judicial states aren't contributing very much to that. It's mostly we're seeing reduced timelines in non-judicial states.
Okay. That's good to know. Another question that we have is what's one data point that you're watching that you feel most people in the industry aren't paying enough attention to?
Hmm. That would be a really good question. I'm going to give you two, only because one is one I kind of beat to death during the presentation. I watch the jobs numbers like a hawk, and there is no way, and we have 200 years of history to support this. There is no way that we see a huge influx in foreclosures without seeing a huge influx first in unemployment.
Yeah.
So as long as the jobs market stays stable, um, I think we're okay. The other number is a little harder to track, but it's something that I believe has an impact more on our market than on the broader housing market, more specifically on our market, which is homeowner equity. As long as homeowners have equity to play with, it doesn't prevent them from going into foreclosure, but it might give them an escape path to avoid that foreclosure sale and to get out intact or at least without losing a lot. And that also plays into short sales. If you have equity, the likelihood of a short sale is not very strong. If you don't have equity, that short sale can go up a bit. So if you're looking at prospects, you need to be looking at what you think they owe on the mortgage, what public record data shows you, and what their actual current market value is to help determine that equity number.
Okay. Thank you for that. And we do have time for a couple of more questions. And if you were left with a question unanswered, feel free to send them over to me, and then I'll make sure that we get an answer for you, as well as sending the recording and the PowerPoint slides to everybody on this call. The next question is looking beyond 2026, is there any long-term shifts that you think could permanently change the REO and foreclosure industry?
So I expect 2027 to have more overall foreclosure activity, um, largely driven by the performance of the FHA book and to a lesser extent by the VA book. But I do think we'll see a significant increase in foreclosure activity next year, both properties entering foreclosure and properties going through the whole process. That will eventually lead to a return of more REO inventory, but I don't expect that to happen at the earliest until late next year. Um, The one thing I would be watching for is if we do see a sudden burst, if you will, of foreclosure activity, depending on the makeup of the House and the Senate coming out of the midterm elections, I would not be surprised to see another foreclosure prevention bill coming out of Congress. So if you get your hopes up that we're going to see a bit of a wave of foreclosure activity hit, keep an eye on what's happening in DC, because they may be emboldened by the success they saw in the forbearance program coming out of COVID and decide that that's the right way to fix rising foreclosure rates every time they happen.
And the last question that we have time for is, do you think that any advances in AI are impacting default servicing or the like REO, not industry, but the servicing industry at all?
Yes, but not that you would notice yet. And I know servicers are looking at AI and trying to use it to streamline their processes. So if nothing else, they can move forward more quickly on what are usually tedious manual processes. I also think we will see servicers begin to use, and this goes back to the last question, Annie, as well, about trends we might see. I think we'll see servicers use AI to try and make sure that they're staying compliant with the plethora of different regulatory constraints and state laws that they need to deal with. One of the things that we saw with the Trump administration kind of scaling back the CFPB is we saw a lot of state attorneys general get more actively involved in mortgages,
Hmm.
particularly when it comes to foreclosures. So servicers now are dealing with the AG in New York and Ohio and Florida and Massachusetts and California coming in with their own rules and regulations. And I believe they're using AI tools to kind of take a look at a given loan and compile all the things they need to be conscious of when they're figuring out what loan modifications and options are available. I also know some servicers who are using AI tools to try and more actively predict which of their borrowers are going to go delinquent or go into default. Um, and that could lead to some opportunities for real estate professionals who could work with those servicers to try and reach out to the homeowner and let them know what their options might be. Let them know that there are paths for them to avoid foreclosure if they need to, maybe by selling their house. So yeah, we haven't seen anything really manifest itself in a meaningful way on the servicing side, but I do think you're going to start to see more of that both on again, kind of these manual processes getting automated and also eventually on some customer interface. Any borrower who's had to go through the pleasure of dealing with a call center in Bangalore um,
Mm.
would probably welcome talking to an AI bot. And I think you'll start to see a little bit of that start to manifest itself in the next year.
Piggybacking on that real quick, do you think that AI driven like layoffs or wage compression, sorry, could eventually show up as more mortgage distress or short sales and foreclosure through not being able to maintain positions that are being replaced by AI?
I think a bigger threat to that, Annie, honestly, is industry consolidation. Um, Mr. Cooper went on a buying spree a couple of years ago where they bought Rushmore and Bayview and Flagstar, and you wind up with positions that are duplicated across those organizations. When Rocket bought Mr. Cooper, we saw something similar happen there.
Mhm.
So I think we'll see some attrition based on that. But you know, the answer might be in your question. You mentioned rising rates of delinquencies and foreclosures. That's a rough time to scale back staff. And at least in the interim, we're going to need that staff to train the AI tools to tell them what to look for. Um, so no, I think the first casualties of AI in the default servicing industry are going to be offshore employees and
Mhm.
maybe contract workers who are doing some of the, for lack of a better term, grunt work that you can,
Freelance.
yeah, that you can
Mhm.
automate. So here's what I just first half of my career, which most people in this industry don't realize was marketing technology companies. And this is about the fifth cycle I've been through of this technology will change everything, starting with personal computers and then going to robotics and then the internet and then mobile technology. And now we're looking at AI. And all of those were going to ruin everybody's career and eliminate all the jobs. And they did cause some disruption, and we will see AI eliminate some jobs. But AI is already starting to create jobs we'd never thought of before, just like all those other tech cycles did. So there's going to be some disruption. We will have some jobs disappear, but we'll also have new jobs come up that none of us had ever even conceived before. So um, don't believe all the gloom and doom.
Okay. That's that part's good to hear. So, thank you again for sharing your time and expertise with us today, Rick. And thank you to everyone who's joined us, and for the engaging conversation. We appreciate your participation, and we'll make sure if you didn't get your question answered, reach out, and we'll be sending this recording once again. So we all hope you continue to stay engaged and keep the conversation going. Thank you again, Rick.
Take care, everybody.
Bye, everybody.